I'm going to talk today a little bit about loss of exclusivity and loss of patent, and what may happen if this is about to happen to you. I'm going to focus specifically on the pricing side of things because that's much more difficult to monitor than the straightforward volume or cash side of things. So you're approaching loss of exclusivity. Presumably you've applied for and gained a 2-year supplementary patent protection period. You may also have managed to get a 6-month pediatric extension, but eventually we'll get to the point where you lose exclusivity and generics start to appear. This is a graph of price, market price against time. The vertical axis is the average market price collected by us, Wavedata, from retail chemists and from dispensing doctors, and it shows the price they're actually paying for the generic or for initially the branded version. So the point at which the patent expired is this peak up there in, I think that one is probably March 2002. Before that period, you had the interplay of the brand, the parallel import, grey market, and subsequently what happened is the actual generic price started coming down like a stone. The little dots on the line are a month apart, so you can see it took about 2 years for it to reach a low point, and after that it stabilized and flattened out. This is lisinopril, similar sort of story, if anything even more extreme than the previous example. Things happened pretty rapidly with this one, particularly with the 20 milligram strength, and the price dropped like a stone. It depends on how big a product it is before it loses its exclusivity, how valuable it is. This is simvastatin, similar sort of story. Curiously, the 10 milligram was relatively stable before the patent expired, but afterwards you can see the price dropped rapidly. But the 20 milligram did some very strange things in the period up to patent expiry. It could be that the wholesalers were trying to get rid of excess volume stock of parallel imports, and then at the final moment they ran out of stock, and the price went up to the reimbursement price for the brand at that time. Lansoprazole, similar sort of story, a fairly rapid decline. Interesting that we start to see bounces here where the price actually declines rapidly and it hits too low a point, and some of the generic manufacturers withdraw from the market and the price goes up again for a while. We'll see those again in a moment. Here we go. So the yellow line here is the average market price of omeprazole, caps 20 milligram, and the purple line is the reimbursement price, the drug tariff, UK drug tariff. So we can see that the price went down very low in the market, and it reached a low point at about 33 months after the patent had expired and the generics were launched. And the price then went back up again for a period. And we will also notice that there were several subsequent small waves, if you see what I mean, that were an echo, if you like, of the first bounce. And this is the 10 milligram form, a similar sort of picture. When we did some fairly involved statistics on this, we found that there was an ongoing pattern, that if the product bounced in price once, it tended to do it again at annual intervals, yearly intervals. We think it's related to the withdrawal and re-emergence of generic manufacturers in the Far East, in India and China. What actually happens to the branded form, you may ask? If you're looking to try and continue your branded form in the marketplace with market share and to maintain some degree of profitability from the product, what will actually happen to that? Well, as we can see, the yellow line is the generic price coming down here, simvastatin in this case, but Zocor managed to hang on with some degree of price level. That as the price declined, it would have been more and more difficult to do brand equalization against the generic. But the fact that there were obviously still GPs out there prescribing the branded form at that point meant that it continued for some years after the patent expired. In many products, what happens is the branded form trails off eventually. However, many companies do maintain commercial departments and keep a brand going for many years by competing, in effect, with the generic form and building contracts with the wholesalers, so that is possible. But one of the key questions is, before it actually happens, when you've still got a year, maybe 2 or 3 years before loss of exclusivity, how are you actually going to be able to predict what will happen when the patent expires and generic manufacturers start to make their own versions of your product? Now, even when we've got a bit of historical information, like in this example, we've got a couple of years of historical information here. Could we draw a straight line here? Could we draw a curve? Could we put it into Excel and draw a nice little simple curve? Well, the honest truth was no. Because the variability in what happens after this period is more than a simple line in Excel or simple mathematics will cope with. And in fact, what happens is very often, to a degree, unexpected. It is, however, to a large degree, predictable. But let's look first at the relationships of different price decline curves in different situations. Now, many commercial managers and exclusivity managers would assume that if they picked up a series of analogues from their therapeutic class, they would be able to, with a straw poll, to have some degree of certainty as to what was going to happen to that product. But when we got very heavily into the statistics, we found that there was no clear relationship between products that are in the same therapeutic class. Therapeutic class was not a good guide to what happens after exclusivity loss and patent expiry. Sometimes the value of the market, what the brand was worth before the patent expired, was a guide, but on odd occasions it wasn't. And it looked as if there was some relationship with the degree of complexity of manufacturing. So if the product was more difficult to make, it would then be decay slower. And again, sometimes you have 3 strengths of the same product, some of them demonstrating one degree of price decline and another doing something completely different. So what actually contributes to making up the generic price? Well, we've obviously got the volume sales pre-patent expiry, the branded sales. We've got the branded products market share, that's relevant as well. We've got the value of the branded market pre-patent expiry, because that's what the generic companies look at. They tend not to think so much about what will happen afterwards. They look at the value at the time. We've also got the brand generic split, how much is already prescribed generically on day one, and the number of manufacturers who are going to actually manufacture the generic form. But also important here is the number of license holders. They may not actually manufacture themselves, they may simply hold a license to distribute. And of course the reimbursement price is relevant. In the UK that's the drug tariff, and that controls to a large extent what will happen and how fast the price will decline. We can also look at the typical growth in the number of generic manufacturers. So this is the average picture we picked up when we were doing the statistics and actually creating models for clients. And what we found that is if a generic product was launched with, say, 5 generic manufacturers, it would increase to about 10, double the number, 200%, after about 6 months. So the first 6 months of activity were pretty critical to what was going to happen to the generic product after that and how fast the price was going to decline. So we got very heavily involved in building statistical models for ourselves and for pharmaceutical clients. And we found that in many cases the price could actually be forecasted. If you knew some of the critical contributing factors, you could actually predict reasonably well what was going to happen. And that generally meant we had to go back and find lots of examples from the past to base the mathematics on. We had to do some degree of forecasting of the generic price. We had to know what the brand was worth before generic launch, and a number of other factors came into play as well. And from that, we were able to build a statistical model, in effect, for each product that had come off patent and for which we had historical information. And that was sufficient to be able to create, in effect, a supermodel, which we used on a number of occasions and rewrote 3 or 4 times over a course of about 5 years. That's enough of the slides. Let's actually go in and look at some real data now. So when a company is trying to get models and getting the statistical data out about average prices which feed the statistics, they can come to our package called the bppi.co.uk, which stands for the British Pharmaceutical Pricing Index, and it allows users to download average prices, minimum prices. But we found over the years that the average price is a much better predictor of price than the minimum or maximum price, although the maximum very often coincides with the reimbursement price. So once they have this information and are able to track that on a monthly basis into the future and have got the historical record of reimbursement prices to that point, if they have some historical data, then they've got something to work on. So building a model, a statistical model, is then possible, which will then allow them to update each month with the key factors such as reimbursement price, such as the average market price, and factors like that. That gives them some degree of surety as to where their price band should be. In order to maximize our profit, we need to stay between this price and this price and tell our commercial guys to make sure they stick in that band, and we will maximize profit by doing that. However, they will also need to understand what the market is actually doing, and this is a second website that we maintain called Wavedata Live, or wavedata.net, which allows us to look for pricing information. It generally has about 100,000 prices added to it each month, and the data stays on it for 35 days to keep it very current, and then is removed and put into the other service. It's also updated every 15 minutes to make sure that everything is current and live and well updated. So I put Residra in there, which is the start of Residronate, and then I click the next button, and I'm going to choose the 25.4 because that's what we looked at on the previous package. And that will then give us a breakdown of the different prices. So I'm making this at the beginning of February 2015, and the current prices at this time, the minimum there is 25, and the reimbursement price and probably the maximum down at the bottom here is no, we haven't got the reimbursement price there, but we've got the highest price there is £19.12. However, the normal highest, here we are in pink, the reimbursement price is £1.54 in Scotland and £1.26 in England. So we can see where the market sits. Perhaps Actavis are quoting for something else for the branded form, but that would then give a commercial manager a very clear view as to which wholesaler was doing what. So he or she would then know if they can approach Sanger's Northern Ireland or Trident or Doncaster or Elite to offer them stock of the brand at a price that would make the company money. Anyway, that's enough for now. Thank you very much for listening. Make contact with us if you need any further information. We'd love to hear from you. Bye-bye.